What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about a report from Morningstar that pretty much mentioned where inflation could potentially be in the next few years. And they are talking about some deflationary risks related to the economy. So I wanted to present that report, critique it, and of course go over some of the reasons why or why not their prediction, basically their assessment of inflation may or may not come true. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. And again, that's all I'm asking in return, is that you drop a like and subscribe. And that 16% annual discount does expire at the end of this month. So you can access all the members-only private videos, trading view charts, all the Excel spreadsheets, stock reports, and the early access to our MoneyVest Pro platform that's going to be available for all the members in early 2024. So link's going to be down below. You can also go to moneyvest.com to join our community. So happy to have you on board, and let's get started. So this is the report they mentioned, and this is inflation expectations for the next 4 years. And the reason why inflation is kind of like the starting point is because inflation is what's driving everything, right? If you think about it logically, inflation drives interest rates, which drives the economy. If inflation is high, right, as we have already witnessed that it's been elevated and it's been higher for the last couple of years, interest rates have gone up, right? The Federal Reserve has been on one of the most aggressive monetary policy tightening cycles that we've ever seen. And as interest rates have gone up, that's putting more and more pressure on equities and on the economy and on unemployment. Even though unemployment is not going up, it's not showing real signs of weakness, but in my opinion, at least, it will in the future if interest rates stay higher for longer, right? It's not so much that interest rates are going higher, that they're staying higher. That's a bigger issue. And if inflation doesn't come down fast enough, there's a chance, there's a possibility that rates stay higher for longer. That's really where the narrative is coming from for higher for longer, and what the Federal Reserve has already mentioned, that they're not expecting cuts at least until towards the end of 2024, the back half of next year is when they're expecting rate cuts. So having a good assessment of inflation is kind of like the starting point of having a good assessment and understanding of rates, and then of course the markets and the economy. So after peaking at 6.2% in 2022, we expect inflation to fall to 3.7% in 2023 is what they are expecting. And this is going to be PCE. That's the Fed's preferred measure of inflation. So that's going to be the personal consumption expenditure, 3.7%. And over 2024 to 2027, we expect inflation to average just under 1.8% and below the Fed's target of 2%. So that's what they are expecting. And this actually is good news. This is a good news, and I'm going to give a thumbs up, because if inflation does come down, well, guess what? Rates are going to get lowered, and that's going to help the economy. That's going to help the markets, of course, because we know that rates right now are absolutely insane, especially the treasury market, which is in complete free fall. The bond prices are selling off, and yields continue to hit higher and higher levels in over 16, 17 years, which is making it more difficult for the market's ability to rally right now. This right here, inflation still heavily driven by a few categories, and they mentioned that the post-pandemic inflationary surge began with only a handful of spending categories, and excess inflation was 6.8% in the second quarter of 2022. Durable goods, energy, and food at home accounted for 70% of excess inflation at that stage, despite being only 20% of the total consumption or the total basket of inflation. And durable good prices were driven up by the semiconductor shortage and the other supply constraints, along with the surge in demand. And energy prices were driven upwards by the unexpected strong post-pandemic recovery in oil demand, along with the oil cuts, which they didn't mention, but along with these sanctions on Russia because of the war in Ukraine. And food prices were heavily influenced by energy prices owing to transportation cost as well. So what they have basically pointed out here is the change in the overall composition of inflation, or really just the excess inflation by category, and what was driving the inflation. So earlier it was mostly energy. So if you come back to 2022, right? So during that time, the yellow, which is energy, was much bigger as an overall percentage of excess inflation. And you can also see food. So that's going to be the green over here. So those two were making pretty significant portions, and durable goods over here were making pretty significant portion of the overall inflation pie, the excess inflation that we were witnessing. Now, what you've noticed is this is where we are in 2023. Yes, they are still pretty excessive, right? So this right here are the three things, but this right here is really where majority of that inflation is coming from. And that's going to be your housing. The other services have really picked up. I mean, other services were really, really low back then, and now they've really picked up pretty big excess of the overall inflation. And then we got housing over here. We've got restaurants and hotels. We got other non-durables that are now making a bigger piece of the overall pie when it comes to excess inflation is what they're talking about. Now, inflation, as I mentioned, has broadened into other spending categories in 2023, somewhat offsetting the deflationary impulse from lower energy prices. And they think that it's likely representing a one-time catch-up in prices for industries that missed the initial inflationary surge in 2022. But we don't think that this will become persistent, a broad-based inflation as seen in the Great Inflation of 1970s. So meaning that, energy prices seeing deflation is going to get offset by some of the other spending categories. But overall, as kind of the markets and the economy normalizes, this is not going to result in the Great Inflation of 1970s. In other words, we're not going to see a broad-based inflation as we witnessed back in the 1970s and 1980s. In other words, they are going to come down eventually. All of them, all the broad-based categories are going to pull back. And we forecast that inflation in 2023, 2027 from a bottom-up perspective. And they mentioned that, given the role of industry-specific shocks, we forecast inflation using a bottom-up methodology, and we're projecting a large deflation in prices for durable goods, food, and energy over 2023 and 2027. So for durable goods, the resolution of the semiconductor shortage should play a large role in expanding supply. And for food and energy, prices should subside as these industries adjust to the disruption of the Russia-Ukraine conflict and other factors. Now, this is the point that I don't particularly agree with, because energy prices, I think it's going to become more and more difficult for oil prices to come down given the supply cuts, given the ongoing geopolitical tensions. I think, if anything, energy prices could potentially stay elevated or keep going higher, as we've already seen with oil prices recovering 30 to 40% since June. So I think this is something that I don't fully agree with, which obviously will affect food prices as well. And this right here is another index called the Supply Chain Pressure Index. And what this measures is how much of a pressure there is on logistics, on shipping cost, captures ocean shipping rates, delivery times, and other indicators that tells us how much of a pressure there is on global supply chains. And the lower, the better, right? So what we are witnessing right now is that it's in negative territory in 2023. That means the pressure has really leveled off on the global supply chains, and it was at its peak when inflation was at its peak, right? So this was back in June and July of 2021 going into 2022. And what that means is that if there's supply constraints, well, there's lower supply, demand is still elevated. That means prices will be higher. But as this number has continued to come down, that's a good thing. So the pressure is kind of easing off from the global supply chains. And as a result, they're loosening up. And if there's more supply, the demand supply is going to be equilibrium and the prices are going to start rolling over. And that is basically the main narrative and the thesis behind the disinflation or the deflation in the overall economy. Now, inflation in 2023, this is not like the 1970s oil price shock. And they mentioned that they expect, and this is what I do disagree with, is what they are mentioning, that one critical difference between today's episode and the 1970s is the nature of these supply shocks, and particularly regarding energy prices. Morningstar's energy team forecasts oil prices to fall to $55 per barrel in 2026, which is going to be the West Texas Intermediate WTI, about where prices were in 2019 before the pandemic, and that's down from an average $70 per barrel in 2023. Oil prices have jumped owing to sanctions to Russia, and global suppliers have been caught off guard by the strength of the post-pandemic recovery. But we expect producers to steadily ramp up production until oil prices fall back to marginal cost of production, which we assess as $55 per barrel. I disagree. I don't know about you guys, but let me know in the comment section down below. What do you think? But given the supply cuts and the petroleum reserves in the U.S. running at their lowest levels, so they've already depleted so much, I think it's going to become more and more challenging for oil prices to come down, right? In other words, they are going to stay pretty elevated, at least in my opinion, over the next several months, several quarters, possibly even going into 2024, 2025. But they're forecasting out to 2026, right? So, okay, we don't know exactly what that next 3 years is going to look like, but it's possible that, we might have to get used to this new reality or this new era where prices do indeed stay somewhat elevated, right? I'm not saying that there's going to be a consistent increase in oil prices back up to $100, $120, $140 per barrel. But given how much supply cuts we're seeing from OPEC plus nations, the SPR in the US, and the geopolitical tensions that I mentioned, and the demand not really tapering off, it's possible that we do stay elevated at close to over $70, $80, $90 a barrel for quite some time. This right here is the housing market cool off. So they are expecting the housing's contribution to inflation to peak in 2023 and fade away entirely over the next year or so. And the Fed's interest rate hikes have thrown cold water on housing demand. And in conjunction with the run-up in home prices, the jump in mortgage rates has driven housing affordability. And they are expecting, so their housing team projects an 18% drop in housing starts in 2023, driven by weaker demand, but the supply of housing will continue to expand at a brisk pace. So supply continues to go up, housing starts to come down 18%, and they expect the home prices to fall by 2.5% in 2023. And be essentially flat for several years. So basically, this is the trend that they're forecasting for home prices. So median home prices, they're expecting to moderate. So we're basically going to be the same as 2022 all the way to 2026, 2027 to basically be flat. So we're not going to see any changes up or down in home prices, what they're expecting for us to see a little bit of that normalization come down to maybe 3% and then start recovering a little bit. But overall, on a 4 or 5 year span to basically be flat from a few years ago. So that's what they're expecting, which is maybe potentially going to help the overall inflation, overall rents, and home prices as well, right? So affordability needs to get improved because right now the price to income ratio is at its worst. Right now it's 7.4, close to 8. As interest rates have gone up, home prices have rallied, and sellers are very stubborn to sell their properties because they're financed at sub 6%. Over 92% of mortgages are sub 6%, right? So those are some things to really be paying attention to. So let me know your thoughts down in the comment section below. I do think that yes, inflation has the possibility to drop down to 3.5%, maybe 3%. But over the long term, it's going to be more and more difficult to assess given all the geopolitical tensions, the oil prices kind of staying elevated, and not to mention, food prices are going to be somewhat directly correlated to where oil prices are because of transportation cost, and shelter prices are also a big wild card with respect to where rents go and, of course, where inflation goes. So, in my opinion, I'm kind of on the Ray Dalio camp, as I mentioned before, that there is a possibility for that stagflation type environment where, we stay above 3.5%, close to 4% for some time, and that's going to be higher than the Fed's target unless there is a severe recession, which obviously takes us down on the price side because demand is going to taper off during a recession, and we are, at sub 2%. And that's when the Federal Reserve starts cutting interest rates to support the economy and start that quantitative easing process once again. But in the meantime, given oil prices and shelter and food, I do think it's possible that we do stay elevated at a little bit over 3.5%. But let me know in the comment section below, what do you think about inflation? Because that's really what's going to be driving overall interest rate expectations and markets and equities and valuations. But let me know in the comment section below. As always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel, and link to our Discord and Patreon is going to be down below. And as always, happy investing, and I'll see you all in the next video.